whatever your situation is, this is at the heart of what the annuity really is. It's a way to take an asset, usually cash, and convert it or create an income stream from it. That's it. We're taking a hard asset, and money just sitting there kind of loses value with every year because of inflation, debasement of the currency. You look at what a dollar could buy 20 years ago, and it's roughly 80, 90% less than right now. And I don't even mean because of the crazy inflation we've had over the last couple of years. This has just been going because they're printing more and more dollars, so every dollar loses value. That's the debasement of the currency. It probably runs, depending on who you look at, 10 to 15% right off the bat. So you don't want money just sitting there. And there are many reasons people get money, either a lump sum, an inheritance, they sell a business, they sell a property. There are very common reasons why, boom, they have a lump sum of money that's just sitting there, or they have excess money, and usually that's invested. So there's money in addition to what they need to live on. It's like, all right, I want this money to start to earn, because the goal for all of us is your money ends up making more money than you do through however you make your money, employment, self-employment, whatnot. You want your money to make more money than you do. So all an annuity is an insurance product that was designed to convert an asset into an income stream. That's it. And it can be a lump sum, $100K I just inherited, I put down in an annuity. It generates income going forward into the future, and we'll talk about that next. Or I have $1,000 a month extra that I don't need. I want that to start to earn money, so that as my earnings come down, the earnings from my money goes up to offset that. That's the goal, because you don't want to end up either without employment, without income. People don't realize how quickly they run out of assets if they're just spending down money. They have no idea of the cost of the future, of healthcare, of everything else that's coming. And so they usually underestimate that. So if I have $1,000, that's an asset of extra money a month, I can put that somewhere to then grow or earn income. An annuity, that's all it is. It's a way to turn an asset into an income stream. All right, once we've addressed that, we've simplified it down, we can now then start to compare it with other ways to turn an asset into an income stream, because that's all we're really talking about with an annuity. Get rid of all the kind of sales pitch and mumbo jumbo and jargon out there, almost designed to confuse, and really boil it down, because it makes the next steps easier. Now, let's talk about annuities versus other options generally, because that should be part of the discussion, whether or not an annuity even makes sense for you. We're not here to sell or push. We're here to kind of address questions and needs. It may not be the best need, but let's look at an annuity strategically versus other options to convert asset into an income stream. All right, let's say we have $100K. We inherited, we sold a business, property, whatever. It's just sitting there. As we talked about, we don't want that to happen. So an annuity is one way to generate an income stream from that asset going forward for a fixed period of time, longer period of time. We'll talk about that going forward in the next section. What are the other options? Well, there are stocks, different risk assets. You could include crypto in that bunch, just riskier, but it's a risk asset, right? There are bonds, which should be safer. We've seen a lot of volatility for the first time in decades on the bond market, but a bond generally has some kind of income stream coming from it, but there is some fluctuation or can be asset risk in the underlying asset you own, meaning it can lose value, right? You could take that 100K and you could buy fixed kind of streams of income, meaning CDs, all the savings accounts. No one's doing that anymore. But for example, CD or money market account, those generate a fixed stream of income, kind of similar to an annuity. And we'll talk about the differences a little bit, and we'll have a whole breakout video on that. You could take that 100K, you could start a business. that should generate income, although 50% of businesses fail. Business is difficult. You may not be in the right place of your life to then dedicate that much time and effort into a business. You can buy real estate, 100K, maybe way out in the desert somewhere. But, generally speaking, there are REITs and different ways you can invest and get some kind of gain. Here's the real difference then between annuities and these other things we talked about, other than the CD money market kind of fixed income banner, is that they have risk. Meaning the stock market, sure, it could go up, but it could also go back down. And it's almost impossible for small people like us to time that, right? We're at an all-time high as I'm recording this right now. So that's tricky going into the next 5 years. Can it go up? Sure. Can crypto continue to go up? Sure, but it can also crash 60% many times during a good market. So there's risk, meaning the value of your 100K can drop. It can drop to 90, 80, 70, 50, 40, depending on how risky the category is. A business is inherently risky. It can fail. So that's an issue. Real estate should go up over time, but it's a headache. The state we're in California, it is definitely anti-landlord. So owning property, people can squat, they can damage things. It's a nightmare. And I know this from my parents in terms of what they deal with down in LA. It's not a business I'm going to go into with that 100K, put it that way, even if 100K would buy you anything. The difference then with annuities is that 100K, depending on how we structure it, especially for the ones we deal with, there's not a risk there, meaning the value of that 100K doesn't go down over time. It can, depending on how we structure it, even go up over time with an index annuity or stay flat if the thing it's indexed to drops. And we'll discuss that in detail in a full other video. But that's the whole point. People who are looking at annuities have 100K. They don't want to lose that 100K. They just want to generate as much income, as high a percentage of income off of that 100K as possible. That's it. That's the big difference. The risk would be the insurance company that offers it goes out of business. But the risk of the 100K going away or going down for market risk, if we structure it correctly, isn't there. And that's the real difference with stocks, with bonds, with mutual funds. With the CDs, it can generate a higher return. And we'll go into that in a whole separate video than your money markets and your CDs and kind of your safer kind of income generating, which is why, annuities have become so popular these days. And we're not talking about variable annuities because a variable annuity can actually lose value. There's risk associated there. That to us doesn't make sense because our goal is to make sure we have a stream of income going forward and not lose our principal, not lose that 100K in our example. That's it. We're turning asset into income stream with a certain degree of safety that we don't lose the asset. Now, that brings us to the two other major components to look at. And then we've addressed a lot of the detail into what we're really trying to do with an annuity. Let's now talk about time frame. All right, the first thing we need to talk about then is timing, and really it's duration. So let's go back to our example with 100K that we have lump sum, we inherited maybe, and we need it to earn income for us. Then the question is, how long? How long are we comfortable with that money being tied up with an annuity? Because if you take it out early, there can be essentially penalties, surrender charges that go down the longer we have the annuity. So if we're comfortable with 5 years, 10 years, then we want to build the duration that we pick around that period of time. So that's the first kind of question is, this money, first of all, it shouldn't be all of our liquid asset, right? It should be a percentage. The rough guesstimate these days is around 40, 50% of your liquid assets, meaning stocks, bonds, cash, things that are readily available or can be converted. So not real estate, not the house you live in, things like that, but more liquid assets Annuities generally shouldn't be more than 40 or 50%. That's kind of like the good estimate out there right now. So for that money that is in an annuity, let's say 100K is 30% of our liquid assets, then how long are we comfortable with that being tied up? Is it 10 years? Is it 20? We don't really need it right now, because the longer it's tied up, the more interest you can make, right? So there's a trade-off there, just like you have with CDs and other vehicles. We're going to talk in a whole other video about a strategy behind how we look at this. But for now, think in terms of timing. How long are you comfortable having that? Then there's a question of, when do I need that income? The timing of that, meaning, do I want income to start right away? Or am I comfortable with income starting in 5 years, 10 years? Now, why would I do that? Because you're going to get more interest. The rate goes up the longer you can defer. Essentially, they're going to invest that and increase the percentage that they're going to pay you when you do start to get paid. So we've talked about timing now in terms of how long it's tied up. We've talked about how long it's going to pay out. There's another aspect here. For some people, annuities, they look at it as a lifetime stream of income, and you can do that. There are payouts where essentially I put that 100K down and I want it to pay for the rest of my life. So it's kind of like reverse life insurance, right? They have a calculation on average based on how long they think you're going to live. Now, the reason people do this is it's locked in. If you live past an average date, you make more. If you live under, you make less. And there are ways to structure it so you don't lose that money. And we definitely recommend that. It'll come back to your beneficiaries, whatever's accumulated plus the base value. So definitely when you want to do that. But then that's another piece of this timing question, which is how long it's going to pay for. Is it going to pay for the 10-year duration we initially planned on? Does it pay for the rest of my life? Maybe the rest of my life and a spouse? So there are different ways to structure all this. And there's lots of wrinkles in how you design that according to what you're looking to do. And there we really have to go through some questions and kind of figure out what your goal is. But for right now, keep in mind the whole question of timing, how long this is going to be tied up, because we don't want to have a surrender charge or a penalty for taking it out early, how long it's going to pay out to you. And that's a whole different aspect of it. Now let's turn to the second piece, which is risk tolerance. And that really is another key in terms of annuity selection. Once we have our timing dialed in, then the second piece to really look at is risk tolerance. So essentially what this means is we already talked about how annuity can be quite a bit safer than the different ways you can generate income from an asset, from a lump sum of money, for example, like the 100K, because the principal generally won't go down. We don't look at variable annuities because in a lot of situations there are cheaper ways to do that. So what we compare are traditional annuities, fixed annuities versus index annuities. And there's a range or a spectrum of risk that we can look at. And what do we mean by that if we're not talking about the 100K? We're talking about the gain. We're talking about the income you can generate from that 100,000. How much, how little, and then how stable that is. So on one side of things, you have things like MYGAs, multi-year guaranteed annuities, which is, it's a fixed percentage, kind of based on where percentages are at that time. It might be 5%, for example, where for 10 years, I'm going to get 5% return on my money. And it doesn't matter what the markets do, interest rates, whatever. That's what I'm looking at is this percentage. And there are a lot of ways to kind of structure that. You can have it relook at interest rates every now and then. And there are different ways to do it. But essentially, you can get a pretty stable fixed return of income on your money with this type of annuity, a fixed annuity. Again, there's a lot of variation there. All the way over to indexed annuities. In an index annuity, the performance or the income you're going to generate from your asset depends on a benchmark. That benchmark, for example, could be the stock market, the S&P 500. So as the S&P 500 goes up, the amount of income you're going to generate will go up as well. Not as much as the S&P, because again, this is safer. The S&P can go down, meaning your 100K put in the S&P could drop to 80K if the market tanks in a year. And we're at all-time highs right now, so going forward, it's kind of tricky, right? So it can drop with the S&P, but on the upside, you can gain more. With an index annuity tied to the S&P, as an example, if the S&P goes up, it will go up as well, just not as much. And because you have this protection or this safety. Now, let's say the S&P drops, it goes negative in a year, drops 20%, something really bad, or a 10% drop. Well, then that index annuity will go flat. Worst case, it'll go level. So you won't get income off of it, but it won't drop. So you've got a chunk of the upside if the index goes up. If the index goes down, you don't have any of the downside. And in some plans, they'll even give you a little minimum amount of income, 1%, 2%, whatever. So if the S&P goes up 15%, maybe our annuity goes up 10%. If the S&P drops 10%, maybe our annuity goes flat, doesn't pay income, or it pays 1 or 2%. So you're kind of trading off. You don't get the high highs, but you don't get the low lows. But you do have gain, which is going to be higher than that fixed income we talked about. So that's more risk tolerant versus the fixed interest we looked at. And our 100K isn't changing. Our 100K is saying 100K. The income that's being derived from it will fluctuate according to the index. So that's where we can participate in a given market. It could be high tech, which can be very volatile, but again, have high highs. And we see some indexes out there, index annuities with 14, 15% average returns over a 5, 10, 15-year window, because they're tied to an index which has been a growth kind of market for decades now. Even with the great financial crisis, it was able to do that. And we love this chart, which shows you over a period of time how this works, and you can take a look at that. So that is risk tolerance. We have our timing, how long we want the income to be generated for, when might we want our money back. We have our risk tolerance, and we have a general understanding of what we're trying to do versus other ways to do it, which is to turn an asset into an income stream. We've now kind of addressed 80% of what we need to think about. Then it's a question of product. And we have a fantastic tool now that will look at hundreds of plans based on your situation to see who ranks best for safety, for the gain, and for the type of plan you're looking at, meaning risk tolerant, risk adverse, and we make it free to you. And so that is the final piece, to take hundreds of plans and narrow it down based on good companies to plans that are best fit for what you're trying to do, knowing your timing and knowing your risk tolerance. Reach out to us. We make this free via our website, link below, and we're happy to help you out with any questions. But now, hopefully, you have a good, firm understanding of what annuity really is. It's a way to turn an asset into an income. All the other stuff is just kind of frill and ways to adjust and tinker with that calculation. And we're happy to do that for you. No cost for our assistance.